Raising capital is a bit of an art and a science. Knowing how to effectively raise capital, whether it's early or late stage, is always going to serve as an asset for you, the CEO, who always needs to be raising. It's the nature of the beast. Having access to capital is critical. Today's show, we're going to talk about how to effectively raise this capital, and if you're not raising it, why that may be. Today, I'm joined by Antonio Barzagli, our engagement partner from our London office. Antonio, welcome to the show.
Hey team, great to be here.
Yeah, so I'm excited to talk about raising capital. Raising capital is one of those things that CEOs should always be raising, whether they're raising early stage or even late stage capital. Having access to capital is very important for businesses of all stages. And knowing how to raise capital is critical to be successful. However, many an entrepreneur, many a CEO fails at raising capital. And I think that's a crying shame because it hinders the growth and it holds back what could be from these organizations when they have access to capital. So I thought we'd spend some time here on this podcast talking about the do's and the don'ts and why essentially these organizations don't raise capital. So starting from the top, just when you hear this conversation, what's one thing that comes to mind instantly when you're like, yeah, that's why they're not raising capital?
Yes, absolutely. There's a theme around traction, right, that I want to talk about, but I don't want to reduce it to that. So I'll start with the audience, and I think one of the reasons is you're not talking to the right audience, right? It could be a mismatch on the stage
Mhm.
between the company and the investor, the wrong industry focus, the geography that isn't right. So, a few examples. A pre-revenue startup that is pitching a private equity group.
Yes.
That's not going to work, right?
And,
The
and why won't
expectation.
that work? Just for education on that for the audience here.
Well, a private equity firm is looking for companies with strong cash flows, scalability, right? It's a different risk profile. It's a different size of the company. So this is a very clear example of something that you won't even get a response at best.
Yes.
Okay. Similarly, a seed stage startup that is going to a growth equity fund, okay, is a bit more nuanced, but we clearly know that you won't get anywhere with that, right? A growth fund is expecting revenue streams, a profitable company, or a path to profitability. The startup isn't even thinking about profitability, right? It's just
Right.
getting
Because that growth fund, they're looking at their capital, like there's some actuality around it, like where the
yes.
capital is going to be deployed. There's potentially, as you mentioned, tractions, there's stats, there's CPAs, CACs, there's all these different metrics that they're most likely going to look at. And for the very
Yeah.
early seed stage company, they just don't have those metrics.
Or differently, a Series A company that is approaching a seed or pre-seed investor, right? The valuation and growth expectations are going to be tough to swallow for a pre-seed investor.
Mhm.
Um, a mature company that raised a lot of capital, went through a lot of rounds, going to an early stage VC fund. That's, again, an example of a misalignment on the risk profile.
Yeah, that's a good
Now,
point. So audience number one is make
yes,
sure that you're
industry
getting,
focus, the other
yeah.
one that we talked about, right?
Mhm.
Say you're growing a biotech startup and you pitch an investor focused on consumer products, right? Beyond the obvious different in focus, a consumer product investor is thinking about a very short path to, right? Versus biotech needs a lot of regulatory approval and trials and tests. A real estate investor or a real estate developer or a luxury hospitality project presented to a tech investor. There's very different themes, very different expertise, very different dynamics. Any tech startup that is pitching traditional investors will probably also struggle, right? There are, those retail traditional investors are more cautious, unfamiliar with a lot of technology, high growth models, and so you'll probably not get a lot of responses there.
Yeah. So just to kind of recap here, audience, And
Yeah.
within the audience, there's the type of investments, the stage of investments, and then there's also the specific industry focus.
Yeah,
I mean, who likes to invest what, where, and if you're going to the wrong people, you're
exactly.
simply wasting time. When you're an early stage company, you don't have time to waste.
And just to complement this first point about the audience, I'd say the geography, there's sometimes we look at the United States as the most prolific market for investors and capital, which probably is. There are many funds that invest cross-border. They have mandates to invest in Europe, in Middle East, in Asia, or in Africa, but it's not the rule, right? Most of the times you probably want to find and target investors where you are, right? Within your network, your community, your region, because it's just a more direct conversation to have. Um, with caveats, right? They might be US investors that invest in other regions and they specifically seeking for those investments and vice versa. So
So
just a note.
that's a good point. Let's talk about geography just for a little further. How important would you say it is to be geographically close to your investors? For a few reasons. One is really just building the relationships. Two is potentially the synergies of the investors and their network and their relationships that might be geographically beneficial to you. How important are those, is geography when it comes to relationships?
Yeah, I think that despite all the advancements that we've seen on the digital, the digital side of investments and deals that got done sometimes without meeting in person, the reality is that this matters a lot, right? There is a language theme, there is a currency theme, there's a regulatory framework, there's a distance to visit. And I think overall there's the fact that there are probably a lot of companies in the backyard of the investors that will land on that table sooner than yours, right? And they will be preferred than somebody that is super far away. There's caveats to this. There's exceptions, right? There's a lot of technology companies that got investments or got acquired from the other side of the world because they had something very, very unique and differentiated from the rest of the market.
Yeah. So this art and science of raising capital, I think relationships, and I want to spend a little time here on the art side. We see entrepreneurs going after money and they just get dollar signs in their eyes. And they forget that behind those dollar signs is a human, is a person that may care about them. There's an investor that wants to know like what's going on in their life, what's going on in their business. We're not talking about publicly traded companies here where you're buying shares on E-Trade or Robinhood, right? We're talking about meeting somebody, spending time with them, getting them to know you and your business organization, you getting to know them, their investment thesis, why they would make these types of investments. Relationships a lot of times are overlooked. So how important is it for an individual to really
100%.
create these relationships as they're on this journey of raising capital?
Very important. I think what a lot of what you're describing could be referred to angels or high net worth individuals putting their capital, their personal brand into an entrepreneur and a company, which obviously there needs to be a great personal and business and vision alignment. But I think this is also true when you move into institutional investments like venture capital, private equity, and so on. These investments are partnerships that can last easily 10 years. All right. And so that relationship needs to be strong. There needs to be an alignment in terms of values. It needs to be somebody that you actually enjoy working with. Because if in the first meetings you're not really in agreement, you're not really loving what you hear, what you see, it's going to be tough to get through, difficult points of your company's growth and all the challenges with that person, with that fund or that investor. And so I think it's actually, to your point, a vetting process for the entrepreneur as much as it is from the investor side.
Assuming that you have a good target market, assuming that you're building deep relationships, assuming your business is worth the investment, and you're actually in front of the right people to speak to. where does it fall off from there, right? Assuming all of that, you finally get your moment, you finally get your meeting. From there, how does it fall apart?
So something for me, having been through this number of times on from both sides of the table, um, I think it's very often is because you can't articulate what your business does and what it is your unique identity. Okay, you can't articulate what your business does and what its unique identity is. Okay, and I'll give you an example here. This is from a company that actually did raise capital, one of our clients. When we started working with them, they had a list of services that went something like managed IT services, IT advisory and strategy development, data analytics for business intelligence, field data collection, KYC onboarding, API service. I can go on for another hour. Okay. And if I ask you what they do, I guarantee you have no idea what they do. When they got to pitch investors, we did a bit of work together. They had an elevator pitch that went more like we build digital identification and verification technology so that people in Africa can access essential services like banking, telephone, and healthcare. Okay.
One sentence.
This, yeah, and this actually addresses a very specific need and problem, and he tells you what you actually do, maybe not in great detail, but you immediately get the problem, the solution, and kind of in what market this plays and how it's different from any managed IT services company. I think a related point to this, to articulating in the elevator pitch, is how unique is your business, right? Maybe, entrepreneurs need to ask themselves, how is my intellectual property and technology different, right? How do I serve my customers better than my competitors? Is my brand more recognized or less recognized than other brands in the space? Can I charge a premium versus my competitors? Can I win more clients than other firms in the space? Do I have strategic partnerships or channels that I've established, right? And there's probably 50 more, but what makes my business so unique that an investor that is interested in that space and in that stage will actually narrow down on my very specific company.
So that's a great point, and that answers the question of where does things fall apart in the actual meeting. So just to recap here a little bit, because you dropped some bombs here. We have knowing how to articulate your message, but articulation is also translated into knowing what truly makes you unique. If you have IP, knowing how to talk about that, intellectual property, knowing your brand positioning and knowing how to address your awareness issues, and that leaks into competition and how you're competing, knowing your pricing positioning, if you're able to offer premium pricing, or what your pricing strategy is, what kind of strategic partnerships you have that are going to give you leverage in the market. And from there, probably a handful of other items, but being able to simply synthesize that information for someone who's on the other side receiving that, to where they go, wow, this person knows what they speak or they're speaking about. Which leads me to my next question, which is, in the meeting, like, how important is it for you to have, honestly, like, confidence, just being confident and presenting like your characteristics and eye contact and the nonverbal cues?
Yeah, I think it's another very important one. I think it's about being confident in the company that you're building, right? In the vision that you have. If you don't believe 110% in your company, well, surely an external audience or investor will not believe even 10% in it, right? And so I admire entrepreneurs first and foremost because despite all challenges and roadblocks, they keep going, right? These are the successful ones that we see, and it might take them 10 years, but they never stop until they succeed. And so I think this is the core element of what you're saying, confidence in what you're saying, in the numbers that you know by hand, in the body language, in taking questions and feedback in a positive way, right? As an opportunity to reinforce a relationship as opposed to getting frustrated. These are all things that I see with successful entrepreneurs that raise.
So, as someone who's raised a lot of capital and been in the game for a long time, let's try to put some frameworks around this. How many investors should the average startup entrepreneur or early stage company speak to pull this off, right? I mean, it only takes one investor to cut you a check, but you need to speak to more than one. So what's a good rule of thumb here?
Is a tough one because there are different stages and different approaches. In our experience, I've seen a recent round that was closed with a venture capital investor. It was about 50 that were contacted in a very select and targeted way. And I've seen other rounds, Series A, Series B, that took sometimes 200, 250 or 200 with a number of follow-ups and back and forth. So I would say I don't like to talk numbers or ranges in this sense, but you don't want to rely on 5 or 10 because reality is, let's talk about this for a second. This is why 5 or 10 may not work. You may not have the exact fit, or the fit may not be as good as you think it is, right? From the description of the investor and its focus. Secondly, they might have already invested most of the money in the fund and they're maybe in capital raising mode. It's not the right time, right? The check that you're looking for might be too small, too big, too early, too late. The person that you're targeting may not be there anymore in the first place, but may not be respondents, may not be so engaged. So there's so many things that can go wrong with a very limited number of investors that requires expanding the list and having a bit of patience finding the right one.
Yeah, and I'm sure you would agree with this, but this is why it's important to enroll a team and smart individuals that are connected versus the entrepreneur who's never done this before and they've never written a pitch deck or a business plan or gone to market with we're not talking about the seasoned entrepreneur that has been
Yeah,
a serial raiser. We're talking about someone who is well-meaning, but they don't have the tools or the contacts to pull this off. I would say it sounds like a list of about 100 that's very well crafted, very well coordinated and orchestrated as just kind of like a foundation because let's be honest, a large portion of that list isn't going to get back to you for the reasons
yeah,
that you listed. Maybe the check size isn't right, the target's right. So making sure that you
definitely.
time there. What are the rabbit holes that you see people chasing that are the wrong rabbit holes where they're wasting time and they should be spending their time in different areas?
A lot of it goes back to, I think, the mismatch, not targeting the right investors. There's another point that I want to talk about that is about not having not connecting the dots well enough between the capital that you need and the business, right? The needs and the investment. I think sometimes this is something that is taken for granted, right? People go out asking, but what are you actually doing? What is your growth plan entails, right? Why do you even contact an investor for and to do what, right? I don't know if it's a rabbit hole, but I think it's an often overlooked item in a capital raising process, right?
Right, right. And do you feel like sometimes people, and maybe this is a rabbit hole where people spend too much time, let's say, on their 100th version of the deck, making all the colors and the spacing, and they're just wasting hours, countless hours, when if you were to ask them to drill down on their financial model or their unit economics, they wouldn't be able to give you a clear answer.
Oh yeah, that's a great point. I wasn't even thinking about that. I would say that first of all, I wouldn't use a pitch deck the first time that I talk to somebody. It's too much, right? It's like not the time yet. You probably just need to have a couple talking points or 3 bullet points to
Yeah.
explain. what you do better than anybody else, why you think you want to work with this investor, and something else, right? That's it. So you don't need the pitch deck revised 100 times in the same way that you probably don't need a product that is at the perfect stage for market. If you're in seed stage or Series A stage, you'll get distracted perfectioning your product or offering a million times and not actually ever present it to the right audience. So that's definitely a rabbit hole that we see a lot, especially with product-based or tech-based companies.
Okay, so we've covered a lot of territory here. I want to wrap this with three red flags that investors see quickly. And I'd like that to lead into your top three recommendations for pitching.
I'd say business is not there yet, and that's an immediate one. You've got a great tech, you built an MVP, you got no substantial sales. You're talking to a venture capital fund. There might be exceptions, but generally that's not going to work. And this doesn't mean the business is invaluable, but it may not be there yet. So scale down, raise a small round, build a business until that point, and reapproach that investor group. Another one could be that your um, industry or business model is not very suitable for raising capital. Okay, it's something that is maybe very asset heavy, very traditional, in a geography that is very particular, and forever unprofitable. There are some, um, I guess you could call them red flags that will make it very hard for any investor to be excited about it. This would be my third. When you expect you need capital tomorrow, okay?
Mm, yeah,
That's actually the definition of a
timing.
red flag, right? In an ideal world, we plan ahead, but you come to a conversation and say, well, I really need this by, the end of the month, or the business will be belly up. I
Yes.
mean, this is when probably first of all, things don't happen overnight. There is a bit of due diligence to do, financials to review, check that, things are in alignment with expectations, contracts to draft. So it probably takes at a minimum 3 months for an investment. And so having realistic timeline expectations is going to be key for any investor group.
Yeah. Okay. And then your top three recommendations.
Number one, present the business to an investor in a similar way you would present it to a client. Different investor groups, but you need to have clarity, you need to have vision, you need to be excited about it, right? You need to involve your team, most likely. The same way you win a sale with a customer, I think you win an investment with an investor. Number two, be prepared more than anybody else. Think about this. Everybody wants to raise capital. There's a lot of noise. How do you stand out from the crowd? How do you sit in that top 1%, 2% of the pack that makes you stand out? And this is you, the business, the website, the deck, the business plan, the projections, the data room, client references, team members that join you. If you are just average or good enough in each of this, it may not be enough for how competitive it is these days. There's another one that you're looking
Final
for me.
recommendation. Yeah.
Well, you can talk to Team Martinez or to our team about this. That'll be my third. There's a scenario where maybe you shouldn't be raising capital, okay? And this is in ways, against our, a lot of the work that we do, but raising capital is a big distraction from running the business, and it takes a lot of emotional energy as well. Okay, so it's something to consider at the very least. Um, it's possible that your business model industry is not very suited for external investors. And so I think a good question to ask yourself is, are there ways to advance my business and grow without an investor? And I'll make a couple of examples. You can pre-sell your products or memberships at a discounted price. You could run a crowdfunding campaign. Doesn't work with everything, but it works with certain things like product-based offerings. You can look into supply chain finance, like trying to finance your equipment or account receivables or contracts from specialized firms. You can look at some other forms of debt or private debt. You can work with a supplier or a large customer to help you out in that early phase, right? You can go a little bit slower, right, and grow organically without deciding that you absolutely need the capital to grow. So I hope that,
Yeah,
um, provides that alternative mindset as well.
that's a fantastic point. Thanks for joining the show and sharing your knowledge. We'll put your contact information down below. And if you're new to this podcast, like, comment, subscribe, follow, tell a friend. But most importantly, reach out and let's make some magic happen. Thanks, everyone.
Thank you, Tim.